Hello, I'm Simran Valecha, a finance geek and a self-proclaimed foodie, and I've been investing in the US stock market for over 10 years now. I've made a lot of money for myself and my clients, so if you want to multiply your money, make sure you subscribe to my channel. In today's video, we're going to be talking about 4 stocks you must invest in if you think the interest rates are going to decline. We received the inflation data in July, and after very long, it was some positive information. After this data was released, the market changed its expectations and is now expecting at least 2.5 rate cuts before the year ends. This is, of course, speculation, but you need to speculate on the future of the economy to decide which companies you should be investing in. But like I always say, invest in good companies that have good products, good management, and that will survive under any macroeconomic conditions. So the first on my list is General Motors. We all know what General Motors does, so I'm not going to spend a lot of time explaining what they do, but they had the best quarterly US sales since Q4 of 2020 with strong pricing and incentives below the industry average. They've had 8 consecutive quarters of year-on-year US retail sales growth, supporting total company revenue CAGR of 16% over the last 24 months. Total US EV deliveries were up to 22,000, up 40% year on year, outpacing the industry average growth of 11%. Production continues to ramp up, guided by the demand. And what I absolutely love is that they announced a new $6 billion share repurchase authorization, which is on track to achieve their less than 1 billion shares target. They've also seen the best Chevrolet Colorado and GMC Canyon combined H1 sales since 2019. In their Q2 earnings call, they spoke about how all their different cars and how their Chevrolet Trax has had a growth of 100% or more for 5 consecutive quarters, and the Buick Envista has had 3 consecutive quarters of record sales. The company is also responsibly growing its EV market presence and capturing new customers, and they're supporting the EV charging infrastructure improvements and have seen positive customer reactions to the new highway plazas rolled out by GM Energy and EVgo with Pilot Company. They also have this really cool technology called Super Cruise, which is industry's first hands-free trailering capability. Super Cruise's sensors and cameras are backed by high-definition LiDAR maps that provide precise road data. They raised their calendar year 2024 guidance, which again is such a positive sign. In terms of financials, their adjusted EPS for Q2 2024 was $1.15, a year-on-year increase driven partly by the 242 million lower diluted weighted average common shares from ASR execution and open market repurchases. The year-on-year change driven by auto business performance and improved working capital through production management more than offset by higher capex and timing of dividend from China and other accruals. GM North America saw a huge increase in net revenue from $792 billion in Q1 of 2024 to $903 billion in Q2 of 2024. They also saw a margin improvement of 0.3%, about the 8 to 10% target range. And their US EV sales also increased from 16.4K in Q1 of 2024 to 21.9K in Q2 of 2024. And they're also on track to achieve their net 2 billion fixed cost reduction by the end of the year. These are all just positive signs, and when you compare this to Ford's earnings results and earnings calls, where company officials essentially said that they would much rather spend money on anything else other than repurchasing shares, which is a huge red flag, General Motors is doing so well. And now that interest rates are going to be cut in September, their GM financial division will do well. They'll see more sales of cars, and the stock price is just going to go up from here. So make sure you invest in it. The second one on my list is Home Depot. It's the world's largest home improvement retailer with retail stores in 50 states. In Q1 of 2024, their sales declined by 2.3%, and they reported a diluted earnings per share of $3.63. However, it is notable to see that they are leveraging their online platform. Their sales through their digital platform increased by 3.3%. The company also grew their market share, and their focus is to grow their pro wallet share through a differentiated set of capabilities and building new stores. They're developing more fulfillment options, a dedicated sales force, specific digital assets, trade credit, and order management capabilities geared at the residential pro who shops across various categories. They're also constantly working to improve the shopping experience and focusing by being in stock with the right products and ensuring that those products are OSA, on the shelf and available for sale. Quality checks are a top priority for the company, which ensures that they can stay number one in the market. With respect to their guidance for 2024, they expect total sales growth to outpace their sales competitors, with sales growth of approximately positive 1% and competitor sales of approximately negative 1%. Total sales growth will benefit from a 53rd week, and they expect the 53rd week to contribute approximately $2.3 billion in sales. Their gross margin is expected to be approximately 33.9%, an increase of approximately 50 basis points compared to fiscal 2023. They also expect operating margin of approximately 14.1%, and they expect a net interest expense of approximately $1.8 billion. Their diluted earnings per share growth is targeted to be approximately 1% compared to 2023. I don't think they're going to record some amazing results this quarter, but once the interest rates fall and home sales pick up, everyone is going to want to buy new home and home products. This is why it's always essential that we buy a market leader. The third one on my list is Weyerhaeuser. It's a manufacturer of wood products. They own and control timberlands and operate as a real estate investment trust. They have an unmatched portfolio with strong ESG foundation and disciplined capital allocation. Like you can see in this image here, they create value at every stage. They've demonstrated continued strong performance in timberland growth, operational excellence, greenhouse gas emissions, and sustainable dividend as well. They have 10.5 million acres held in the US and 14 million acres in Canada. They're the largest timber REIT and have a competitive advantage. They also have a strong export market, mainly China, Japan, India, and Korea. Essentially, they have scale, consistent product quality, and supply chain reliability, which gives them a competitive advantage in the local and export markets. They also hold the number one position in the adjusted EBITDA per acre. In their last earnings call, the company executives discussed strategies for the future and how they are planning to return cash to shareholders as well, which is a big positive. However, for the quarter that ended in June 2024, the company reported a revenue of $1.9 billion, down 2.9% over the same period last year. EPS came in at $0.21 compared to $0.32 just a year ago in the same quarter. The company delivered an EPS surprise of negative 4.5%, with the consensus EPS estimate being $0.22. The overall industry isn't doing well given the high interest rates, but there's a lot of scope for these companies' revenues to grow once consumers start buying more homes, once financing those homes also becomes affordable. Since we got positive news on inflation data itself, the stock price has increased from $27.58 to $30.6. Of course, this is just a small increase, and that's just basis some positive news. Imagine what will happen when interest rates actually decline. People take on more home loans, people buy more homes. You'll obviously need more lumber and timber. So, this stock is definitely one that you need to buy in your portfolio before the Fed announces a decline in interest rates. The third one on my list is a consumer staple producer and has been a market leader for years. The consumer staple sector essentially produces and sells essential items such as grocery, household cleaners, and hygiene products. Companies in this sector include retailers like Costco, Walmart, Target, and manufacturers like Colgate and Procter and Gamble, of course. So in today's video, we're going to be talking specifically about Colgate. It's a $19.5 billion consumer product company with 34,000 diverse and dedicated people serving over 200 countries and territories. They've also had a very long history of global success. And they're global share leaders, which is why I picked Colgate of all the brands. But I will make another video on consumer staples, so make sure you subscribe to my channel. Colgate's strong results this quarter and in the first half of the year add to their and my confidence that they are executing the right strategies to deliver on the increased 2024 organic sales and base business earnings growth expectations. They're driving cash flow and generating consistent compound earnings per share growth. Their net sales grew by 4.9%, organic sales grew by 9% with balanced volume and pricing growth. On a base business basis, this was their fourth consecutive quarter, delivering double digit operating profit growth along with a double digit increase in advertising to support brand health and strong innovation. They've continued to deliver year to date value market share growth in toothpaste. They've maintained their 2024 net sales guidance constant 2 to 5%, including a mid single digit negative impact from foreign exchange. The advertising cost is up 18% versus Q2 of 2023, which was planned, so I'm not too worried about it. Plus, it has led to increase in their market share. They are expecting their raw and packaging material costs to increase modestly in 2024, predominantly driven by a year-over-year increase in their transactional impact of foreign exchange and commodity costs are expected to increase sequentially in the second half of 2024. I like that the company continues to innovate and tracks revenue and market share for each innovation. They reported second quarter adjusted earnings of 91 cents, beating the Wall Street calls for 87 cents. Their net sales of $5.06 billion were also above analyst forecasts of $5 billion. They also increased their organic sales guidance after topping their Q2 earnings estimates. Consumer staple stocks are going to continue to grow quarter after quarter irrespective of the macro situation. Hence, it's always advisable to keep at least one consumer staple stock in your portfolio. If you found this video helpful, make sure you subscribe to my channel. See you next week. Bye.